Alrighty, folks, welcome on back here to the Diagnostic Trading Hour right here on TFNN, stream to you live inside the Signal platform and on your mobile phone at tfnn.mobi. Let's check out where the markets are at right now. S&P is currently down along with the rest of the indices, down 10 points. We got Russell down 11, Nasdaq's down 3, with the Dow down 119 points on the day. Looking over at copper, it's down slightly, down about 1%. However, gold and silver are up. Gold is up 17, almost 18 points right now, over 1%. Silver nearly 1% up right now. We got natural gas down 9%. Yes, that's right, 9%, a massive move. We got corn is currently up $2. We got soybeans down 12. Pound dollar is currently up 34 pips. Euro dollar is down 58. Euro pound down 56, with the U.S. franc down at 25. U.S. yen is currently up 115 pips. Still getting those nice big swings there. We got Euro yen up 63. Aussie yen up 51. Aussie dollar down 45. Looking over the bonds, they are slightly positive, with the dollar index as well. King dollar rallying on up right now today. And we got oil. Oil is down $1.93, down nearly 4% on the day, down to 47. Just some massive moves there in oil. And I've been enjoying that for a while there. We got pound yen is currently up $2 on the day. We got the euro franc continuing to plummet, down 110. Pound franc sort of leveling off at the moment from yesterday's close, down 10 pips on the day. Looking on over at some of the headlines here. Let's see what we got going on. We got the New Zealand dollar falling to 2-week lows, so flying on down there. Gold surging to 4-month highs, so as it moves on up right when it broke up just above the 1,300 there. So like I said, some nice moves there in the metals. Been having that for a little bit with all this FX volatility spreading around. We got the dollar CAD is hitting fresh 6-year highs above 1.21. So dollar CAD really moving on up there. So let's see here. Stocks might get a little boost or, bust. I guess we'll see. Right here on the State of the Union address. That's scheduled, looks like, for 9 o'clock Eastern tonight. So don't forget that that's coming out tonight, especially if you have any positions on. There can be some interesting volatility depending upon what's said and how it's said. Obviously, some of the stuff's already leaked out. But just be aware that that's coming out at 9 o'clock Eastern tonight. So you'll want that on your calendar if you're trading in the evening. So Canadian dollar itself, dollar CAD flying up, Canadian dollar plunging. We talked about dollar CAD hitting big highs. Well, that was plunging on soft manufacturing. So that basically made it take that hit. So IMF cutting the forecast globally, saying things don't look as good as we think they will, because it's forecast on oil, causing oil to fall further. Iran even starts talking about selling oil as low as $25 a barrel. So just sort of obviously a very big announcement there, and highly impacting volatility, all this oil stuff, all the, the franc, all the big news that's been coming out. And Iran starts right there, just looking at that over here on Reuters, talking about a $25 barrel oil, just adding more volatility to that. So trading on down, it says down to 46.23 as of this report came out. And so anyway, just sort of what's behind it doesn't help you a lot while you're trading. You got to follow the charts, but you can see the news that is causing the volatility, and sort of look back on that. Going on back in, checking out some of the other top headlines. We got silver popping up at $18. So actually went on up to $18. So along with gold, like I said, hitting 1,300 highest in 5 months. So some big moves right there. So that's even with the dollar index moving on up for the day. So some interesting dynamics, how things are playing out. People are moving, in fear over to those metals there. Obviously, we got the FX markets going crazy for the last few days. We talked about this last Thursday. And the Switzerland Bank, the SNB, Swiss National Bank, or the Fed of Switzerland, basically came out and they had a cap on the euro dollar at 1.2, where they'd go in and basically been setting, buying, selling bonds, whatever process all that takes. We can get into the details, but bottom line is they were making sure the euro franc did not drop below 1.2. Just 3 days earlier, they said that it was, like a foundational thing of their economic policy. to keep it at 1.2, and they surprised everyone and dropped the entire peg just overnight, just boom, and ripped the Band-Aid off, but like more like a massive wound. And that impacted all of the FX markets that the bid offer spreads on dollar franc. I mean, I've seen them at 10 easily, but even as high as 25. Lots of volatility there. We're seeing, 100 pip moves, just everything. Like Friday was just insane. Even yesterday, today, we're getting some good moves on some of the FX markets. We got some other things coming up where, let me see here. Let me pull this up. I'll open up a chart. And we'll even look at, we've got the Euro bond auction coming on out. And Draghi was, when I was looking at over the weekend, he was talking at doing $1 trillion QE with all this. And so how far he falls through on that at this point, does he even need to do it at this point, now that he got his inflation by, hurting the, by the Euro franc going in and dropping that peg. So Euro, but Euro went down, therefore it got more inflated. Franc went up, therefore it got more deflated. It's weird, but it's backwards. Okay, so if the Euro versus the franc, if the Euro goes down, that's inflationary. It's worth less money, so it takes more money to buy things. Okay, so if it's the first in the two FX pairs, whereas on the Euro franc, the second pair means it got stronger. If the market goes down, if the market goes up, then the first pair got stronger, the second pair got weaker. But that also helps you understand inflation, deflation. If it goes down, then the Euro got inflated because it was worth less. The franc got deflated, meaning it's worth more. All right, so just looking at some of the volatility that we've seen, I'll get a couple charts open. We'll flip through them and put some stuff up here for you and go through it. But like I said, just some crazy volatility, been perfect for trading, on Nadex. If you haven't checked that out, we'll talk about that as well. And but during these kind of crazy times, where do you want to trade? Probably somewhere where you have cap on risk, some safety. Obviously, FXCM, they got nailed. They lost over $200 million. They had to get a loan for $300 million. And I would say the interest rate could go up to like 17% on it, which pretty much means that they will be handing over their company to whoever they gave the loan to. But business should operate as normal. It's just ownership will change hands. You got IG took a hit like of 20-something million. However, they have like 80 million or something like that in reserves. So, they have the money to take the hit. IG Group owning IG Index, and they're actually looking at not only that, but they make like 40 million a quarter, and obviously will impact their quarterly results, but it's not detrimental. And they're even looking at buying some Forex brokers. I saw some news where they're looking at buying Oanda potentially. And obviously they're all rumors until they're done, or buying pieces of Oanda, or probably the customers, or I have no idea exactly how they're going to handle that, but they're looking at taking that over. And then let's see what other. See, there's Oanda, and then there is two other major ones. It may not be Oanda. Actually, it may be a different one. I may be misquoting on that one. So I'll look it up and figure out which one that was. There's one of them I know I saw they were looking at buying last time I checked. Anyways, getting back on track here. So obviously that hurt a lot of the FX brokers. Some brokers came out really good. Actually, it was Oanda, I think, that forgave all negative balances. So I do have that wrong. Oanda forgave negative balances for anybody who went negative due to margin calls, which is pretty impressive. The only reason, of course, that I can think of that would be possible is because they were trading directly against the market, meaning like they were on the opposite side. They didn't actually have a opposite position. So basically they were making money when all those people were getting slammed. Therefore, it's basically they were just, forsaking profits to not have all the bad news on margin calls, get the good press out for giving debts on those. It was Alpari. That's Alpari. Yeah, now I remember. Okay, Alpari is the one who was looking at, IG's looking at buying part of. And then, there's a whole slew. We'll see what all comes out on quarterly statements, of course, after this quarter on how it affected, Goldman. I want to say Barclays. I believe it was Barclays who lost 100 million on it. Interactive Brokers took a pretty massive hit, but it was only 2.5% of their gross. So they're like, this really is, it's a bad day, but not a bad event for them. Of course, they have higher leverage requirements, or I guess lower leverage requirements, higher margin requirements for many of their pairs over on Interactive Brokers. Obviously, Nadex itself, not an issue. Why? Well, when you're thinking about, where you want to trade, one of the things you want to think about is not only the ability to, get good leverage and get good margin, get good fees, all that stuff, but you also want to think about the stability of where you're trading. Nadex makes both sides of the trader, whether it be a market maker or whether it be a trader, put up their max risk. And, if you want to check out Nadex, you can hop on tfnn.com. On the right side of the page is a Nadex banner. You click on that, and it'll take you right to Nadex's website. But let's say we put on a trade and there's a $200 value on that option, on that spread option. And let's say I buy it in the middle, you sell it in the middle, just getting rid of bid offer just to make things simple for a moment. So, I bought it right in the middle, you sold it in the middle. So I have $100 risk if it goes down, you have $100 risk if it goes up. I put up $100, you put up $100. All the risk capital is there. So since both sides have put up the maximum risk capital on the contract, then the money is there in order to ensure that the winning side of that trade gets paid. And also doesn't put the exchange in a point where they don't have the ability to deliver whenever that trade is closed. Therefore, basically allowing you to trade at a place where, since all capital is put up on both sides of trades, and with your money being segregated as well from the company, classified as swap under CFTC, it's all the money you put in is segregated from the company's assets, making it very easy for you to be able to go in and get your money out should there be some sort of Nadex problem. But there won't be a problem because of market crash on Nadex, specifically because the money is put up on both sides. On FX, you go into high leverage, take a Alpari, for instance, or something, and they're not heads off, and flies down and blows up. So we'll talk about how that can impact you as well, and steps you might want to think about taking if ever anything like that happens in the future. Stay right there. We'll be back after this break. All right, welcome on back here to the Diagnostic Trading Hour. And so what we were talking about right there at the end was, if you're at a broker and the broker ends up going negative because of some complete 40 deviation move event, obviously the assets need to be segregated, everything else, depending on what broker you're at and what regulation they're under, that can vary, but that exposure is there. So, and there's not necessarily the protection for you just to get a reimbursement like on stocks, like when you're trading futures and Forex. And so that's one reason why you might want to go over and check out Nadex, like I said, because both sides, risk is put up on the trade. And that gives me a lot of comfort in knowing the stability of the place where I'm putting my money and trading. Also, obviously, it's smart to make withdrawals out of an account. So the whole point you are trading is to make withdrawals, right? That's the goal. So you put money in with the goal of pulling more out. So make sure you're making withdrawals, not just, getting all, ego driven by the account balance size. Let your checking or savings account, let that one grow, okay? Not your trade account, pull out, if you make 1,000, pull out 500, that type thing. Something else, if you see something like that and you have a reason to be nervous, like FXEM, they're net negative, they, CFTC's, looking into it, like all that news comes out, Thursday night, Friday, then, or actually, I guess really Friday morning, and CFTC's looking into it, you're really nervous, what can you do? Well, you can also, you could withdraw funds, let the wind blow over, see if it's all good. If it is, you can go back, go somewhere else, whatever you want to do. If you do withdraw funds, you may want to do a wire, not an ACH that takes 4 days to clear, so it doesn't bounce or something in between, or they declare insolvency on Monday, and then what do you do? So, not encouraging you to do these things. I'm just trying to get you to think about, if something like that came up and you were extremely nervous, what would be the actions you might want to consider taking? Well, if you were really nervous, obviously you want the money in your hand, and if I have to lose a couple days trading, putting the money back, that's one thing. So I better lose my account. And again, not looking at ACH so much as looking at wires. So again, I hope nobody ever has to do that. I'm just, I'd rather tell you now as you go, oh, that would have been nice to know later. these are just horrible things that we've seen. You've seen with MFG and all these other things, and just a lot of things. Is how can you best be prepared? So one of them is having a plan of, well, how am I going to withdraw my money? If I can withdraw it, how am I going to withdraw it in the fastest way possible? Another one is looking at, what is the regulation of where I'm trading? Is it U.S. regulated? Is it international, where there's different regulations? Are they as good? Do they protect me? And then, is there something in there what's in there to protect me along the way if something does happen, if anything? And that's one of the many reasons why I like Nadex, not only for myself, but for my account's sake, like my account and, my own trading. And some people go, well, yeah, that Nadex thing, but those binaries, maybe, I love them, but you don't. Maybe you're like, those binaries just really are not for me. I like trading futures. I like trading Forex. It's simple. It's easy. You buy, you sell. There's no choices, on down the list. So what would be a way to potentially trade this and get those benefits of that, both sides having the risk put up, everything else? Well, one way would be to do what's called like the middle or master spreads. They're larger spreads. And let me show you this. This is sort of a way to mirror futures and Forex and things like that when you're trading them. As you go in, and you literally just find the really wide spread. Okay? Now, I'm not saying this is the best method. I'm just bringing up a method, because the margin may be higher than you used to. I don't know, if you're used to, what you're used to doing. But the more you're in the middle of a spread, the more the spread will have a delta of what's called a delta is 1, how fast the spread price moves in relation to the underlying. A spread tick value is always $1, and it always ticks in 1, whether it be 1 or 0.1 or 0.01 or 0.01. It's always a tick value of $1 per tick. Now you can do 10 contracts, 1 contract, 12 contracts, so you can ratio your tick size, which is nice. But just because the spread moves, just because the spread's tick value is $1, doesn't mean that, when the underlying market moves 10 ticks, that the spread's going to move 10 ticks. Why? Well, it's like any other option. It uses what's called a Black-Scholes model. There's premium built into an option. So if that's an issue for you, you may want the premium, you may want to avoid the premium. There's all different ways to trade them. But if you're looking for simplicity on how to trade the spreads, then that's where understanding this proximity thing, this delta thing, comes into play, and it's a lot simpler than it sounds. We'll talk about it when we get back. All right, folks, welcome back here to the Diagnostic Trading Hour. And so just talking about spreads and how you can use those in your trading as a potential way to go in and decide that you don't want to, how do I put this? You want to have capped risk on a trade, trading like a future or Forex. Then you want to find spreads that have a very close proximity, ideally somewhere in the money. Now, looking at this, I see a 415 and a 415 spread right here on the spread scanner, both on the S&P 500. One's like $200, one's $400. Now, the $400 one, why is it $400, to put up there? Well, that's because it's a wider spread, 800. It can go up like 40 points. Do I expect the S&P to move 40 points today? No. If it does, there'll be more spreads I can buy. So my better choice is to get one that has this low proximity, still gives me the same amount of time. Okay, end of day, more like a future. Usually most traders, day traders, are closing out end of day. You can always open another one up when it reopens at 6. But it gives me more time right there. And same amount of time, but less max risk on the trade. So what if I'm trading FX? We can go over here. We'll look at a couple FX. Go, okay, what is available? Again, somewhere, close to the middle. Looking at, say, 3 p.m. And on the buy side with a really low, okay, a very low proximity. And ideally some room to move. Like this one has a low proximity of 1, but it can only make $20. This one can make up to 143 ticks. Well, yeah, I know it's capped at 143. Most of the time, that should not be an issue for you. If it is, there'll be another spread. Okay, that's the idea. This one, yes, it can make 358 ticks. I don't know who expects to make 358 ticks today on Eurodollar, but beyond odd, market events, and people go, well, I want to be able to make those ticks. I want to have that room or whatever. It's like, well, other spreads come up, other binaries come up, all that. But you also, with that ability to not have any kind of cap on profit of like 140 ticks, like that's a big problem. But without having that cap on profit, you also get the cap on risk. If you don't have the cap on profit, you don't have the cap on risk. Okay? So now that's one method. To use the spreads, just find low proximity. What that means is it's trading at a price very close within a few ticks of where the underlying market is, which means it's going to be moving at just about 100% of the underlying market if you have that low proximity and you have some room to run. Basically, we're somewhere in the middle of that spread. It's 11,445 by 11,695, currently quoting at basically 1550, 1.1550. So right in between 445, 695, we got 550, the current quote. So that quote is very close to where the market's at. And I mean, we can open up a ticket on it. We can see, where the euro dollar is currently trading. Or we can go over here, see it's trading at 1.547, 1.550. So it's right there within a few ticks of the market. And now I have a capped risk on my trade. By the way, if you were to do this euro dollar trade on Forex, okay, you'd be putting up, quite a bit more. Let's figure out how does that margin work? Okay, how do you calculate that margin is? So if I'm looking at euro dollar and I'm doing it what's called a mini lot or 10,000 units of currency, okay? Multiply that times the price, so 1.1550, okay, and then divide that by, you get 50 leverage here in the States. I'd put up $231 to do a mini FX contract, a 10,000 unit contract right now. All right, 231 bucks. That'd be the margin I would have to put up, plus my floating P&L. Again, plus my floating P&L. So if I lose, 40 ticks on the thing, now I have 270. Okay, because I have 230 margin, I'm down 40 because it's taking the profit out or the loss out live. Okay. So if I go over here and I look at this, well, even the one that's at 3 o'clock, the really wide 600-point spread that's been trading since yesterday at 6 p.m., okay? Or sorry, it's been trading since 7 a.m. So 7 a.m. It's been trading since 7 a.m. On this spread right here. And actually, the 600 one starts at 6. That's right. So actually, it started at 6 o'clock last night. And then you get 3, because you get one master spread, and then you get the other spreads. That's why there's only one of them, okay? So that one master spread, I'd be putting up about the same amount in margin as I'd be putting up on an FX pair to do the trade. What if I was to go short that same spread? Go down here, there's the 250 wide one. It's a little bit more on the short side just because we're a little further down inside the spread. So we put up 363 versus 231. If I went with the master spread, okay? And when I say master spread, let me go over to Nadex. Let me show you right here. Under markets, we'll go to Forex, and then we're going to go to contract specs. We'll go down here to spreads, find the euro dollar, the widest spread, trades from 6 p.m. to 3 a.m. That's that 600-point wide spread, 6 p.m. to 3 a.m. Okay, so it's literally, you could be trading that spread all day long and just that spread. And it's so wide, it's made for that. So it's called the master spread. You can trade it all day long, use it to mirror the underlying market. And it will go, basically, it will go fast with the market. Okay, market moves down, it should move down a tick or so. Market should move down about a tick. For every 2 ticks, you should see about a 2-tick move. So over 10, maybe you see 9 to 10 ticks. Okay, so it's moving very fast. But you have that capped risk. Well, at 7 a.m., these 250-point wide ones popped up. And you only put up 248 on the short side. On the long side, you only put up 103 in margin, half the margin. So literally, you're getting double the leverage in the sense of you're putting up $103 to control 10 grand, okay, 10,000 units in currency. So really, that's more like $11,549, and then 10,000 euros. So to control like almost $11,500 there, you're putting up $100. But you have a capped risk of 104. So putting your margin closer to like 100 to 1 on that trade versus just 50 to 1 like you get over on the Forex market, and without the protection that you don't get on the Forex market. So something, definitely to consider and look at. I mean, showing, margins not that much different. Sometimes a lot better, sometimes a little bit higher, depending on which spread you're choosing. But there are multiple spreads. So if we chose the 7 a.m., we're right at the ballpark. The one that started at 7 a.m. went to 3. If we chose the one that started at 6 and went to 3, we're a little higher. On the short side, we're a little, we're pretty much on par on the long side. We're pretty much close to, on par on the short side on the one that started at 7 a.m., and we're a lot better on the long side. Again, that's because we're lower in that 250 points. We're 104 down, there's 145 to go. Okay? So I just want you to, think about, like, this is why I like it as a trader. It's not just, hey, Nadex. Like, I have capped risk. My leverage can be similar, especially on FX. Okay, especially on FX. And I don't have to worry about the broker going bust. There is no broker. There's just the exchange, and the exchange makes the other side put their trade up. So if something massive does happen, it's not like the exchange is upside down, waiting on margin calls to come in that may or may not come in because the exchange already had them put their money up, so the money is there. And so there's a lot of ways to trade spreads. I've talked about ways to trade them as, straddles and as iron condors, and you can do what's called double spreads, and, you calendar them. You can do all sorts of crazy things with them. But the main point here being the simplicity of capped risk. Now, you could go in and you could decide to hedge, where you, buy, like you think the euro dollar is going to go down now, you could, buy a spread and sell 10,000 units of currency. Buy 10 spreads, sell 10,000 units of currency, or 100,000 units of currency, okay? So you can do that either way. But, of course, you only have protection up to the max profit on the spread, not if there's a 2,000 pip move, right? So if you were short on the Euro francs on that day, or the US francs on, say, Nadex, I mean, you had a capped risk, flew down, you made max profit, awesome. If you were long, you had a capped risk, you only lost what your max risk was. There was no worry about getting a margin call or your broker being in trouble or anything of that sort. So, but anyways, but I know I'm sort of, going on and on about this point, but I'm trying to just make sure it's really, really clear, because I think it's one of the most important points I can make for you in trading is understanding that value, that capped risk. Because some people are like, well, what could I have done? Is there some way I could have foreseen it? This, that. I mean, you could have known there was news coming out, obviously, just by watching economic calendars and been out of the market, but that doesn't mean something like that couldn't happen unexpectedly. So it doesn't completely protect you, but at least on this event, you knew there was going to be an announcement. The other thing is you could trade Nadex and have capped risk, Anyways, just some thoughts for you to ponder on there. And, because obviously going back and doing a little, like, what if I was in that trade? What could I have done? How could I have handled it? Are some of the questions that come up. And so just trying to, answer those for you and help you out. Some other things we want to go over is make sure you do have the news for today and that you're all set up for, these upcoming days here that are going on. Another reminder, just sort of, it's not really news, but sort of news. Oil rolled over. So we got oil into the new market here. And of course, we have oil inventory tomorrow coming on out. Make sure you have that one on your calendar. If you're an oil trader, you should know that oil comes out usually on Wednesdays, almost every Wednesday, unless there's a holiday. Sometimes they bump it. There was a holiday this week. Did they bump it? Let me just double check. It depends on what is closed and what's not closed onto whether they bump it. And let's see, 10:30. Okay, looks like they are bumping that it is bumped to Thursday. So we'll be on Thursday this week at 11 a.m. Okay, so a little bit different time. But Thursday at 11 a.m. is when oil inventories will be released due to the Martin Luther King holiday on Monday. And let's see here, going into some of the other news events that you need to be aware of. Here on the 20th, tonight, we have the Pound MPC purchase facility, official bank rate and various reports. So a lot of stuff coming out tonight. With all these, usually we get even unemployment rate, all that. So a lot of stuff coming out tonight on the pound. Usually a good straddle setup Looking for a risk less than 40 bucks on a trade. So when I say less than 40, that means what I do is I combine it. By the way, that report comes out tonight at 4:30. You can enter as early as 11 o'clock, obviously as late as 4, and then set your take profits, okay? So go in here, and how do you find a straddle? It's pretty easy to set your risk reward to 1-to-1, max $100 risk, choose pound dollar, scroll down, find a combination that expires after the report, being at 7 a.m. Right there, and then so find one that has the same floor and ceiling, 5160 and 5160. Like that combined risk is $18. That's less than 40. Okay, and then set your take profits in there. We'll go for a 1-to-1. That's how you do a straddle. So tonight we have that straddle coming out. Just make sure you're aware of that. Some other news coming out this evening. Let's see here. What do we got? We got Aussie dollar, Westpac consumer sentiment. Not a major trade event, but just one to be aware of. It come out at 6:30. Then we got the yen monetary policy statement's going to come on out. Who knows what may come out of that, especially based on what happened last week. And that may throw a monkey wrench in their plans. The franc messing with everything. So at 11 o'clock, that will be released this evening on the yen. Be aware of that. And let's see, tomorrow, we got the WF meetings, day 1. And, of course, we'll have them day 2 and day 3 and day 4. They actually go from Tuesday through Saturday, okay? And the WF meetings basically is a World Economic Forum. It has central bankers, prime ministers, finance ministers, trade ministers, business leaders from 90 countries. So basically any comments coming out of central bankers and things like that from that meeting can have a significant surprising influence on the market. That'll be happening over the next 4 days. Let's see here. What else do we got? We got the Yen Bank of Japan press conference will be at 2:30 tomorrow morning. Okay, so that, again, depending upon how that report comes out from the previous evening there, and then how this comes out, we could have some volatility. Earnings, we got United Technologies. Let's see here. We do need to confirm that one. Let's see here. I'll look that up here in a second. We'll come back to it. But UTX just confirming its earnings release, and I just have not confirmed on my calendar. So whenever I pulled it up originally. And let's see if that is confirmed. Usually I have those done. Let's see here. UTX Finance next earnings date is going to be January 27th. Okay, so they bumped it. All right, so we need to bump UTX to the 27th. Okay, that's why I like to confirm those. Be back right after this. Alrighty, folks. Welcome on back here to the Diagnostic Trading Hour. So yeah, I did confirm there's going to be the following week, so we'll update you on that one later, but it's definitely not this week. It's the following on the 29th there. Going on forward, what other things we got going on? We got CAD wholesale sells news coming out at 8:30. Sets us up for an iron condor on Nadex. That's using the spreads to collect premium, buying the spread under the market and selling the spread above the market. So one spread below, one spread above. Iron condor looking for a minimum of $30 profit, entering at 8 a.m. with a 10 a.m. expiration. On that, we also have the U.S. building permits, 8 a.m. to 10 a.m. on euro dollar. That's buying a spread below, selling a spread above on the euro dollar for a $30 minimum profit. And a variety of CAD reports. Be a little careful on this one, just due to current volatility in the market, especially on dollar CAD with those new highs. Usually, there's only about 30 pips of movement on that trade as well for potential premium collection trade. There will be a Canadian press conference after that. You'll definitely want to be out by then at 11:15. So that can cause some volatility in the CAD. New Zealand will have some manufacturing reports coming out tomorrow at 4:30 for New Zealand dollar traders. Aussie is going to have its MI inflation expectations, usually not a big mover, coming out at 7 o'clock. Going into Tuesday or Thursday, just getting you caught up. Like I said, WF annual meeting day 2. Spanish unemployment coming out at 3 a.m. can impact the euro. So usually it's pretty bad right now, so there probably shouldn't be any massive surprise there. The pound public sector net borrowing at 4:30 on the pound. Can have a little bit of impact on those pound traders out there. Pound CBI coming out at 6 a.m. on Thursday. Then we got Verizon, that obviously can impact the Dow, coming up on the 22nd there. Will be released before market opens at 7:25 is when the scheduled releases. And then we go on in, we're going to have, this is big, minimum bid rate. Usually, when the bid rate comes out, usually, there is not a massive surprise, okay? But either way, I mean, we saw what happened with the Swiss the other day. Most of the time, this trade works without a hitch, 30 bucks, Iron Condor on the trade, so you can look at that as a potential setup. When the movement does start happening is after the trade comes out. And you know what? I need to update that. We should have an expiration of 8 a.m. because we want to be out of this thing before the press conference. Let's see here. So make sure, again, you are out of that. I'll update that on my list. The press conference will be starting over here right on this at 8:30. So you want an 8 a.m. expiration on that trade, okay? 8 a.m. expiration on that trade. And let me mark that note. Okay, and then, so the ECB press conference, that can usually be pretty wild. That also is often a straddle. So looking for about a $40 straddle on that. I'll update that with straddle on it. But usually looking for a straddle on the ECB press conference. We also have unemployment claims coming out at the same time at 8:30. Natural gas. Let's see here if it's on its scheduled time. Natural gas will be coming out at 10:30. Okay, and oil inventory report coming out at 11. So we got that updated. And then China will have some events coming out, PMI at 8:45 on Thursday night. So just be aware that that could easily affect your Aussie and yen trades. And then we'll have a pound retail sales trade there on Thursday evening. And we'll talk about how to set that trade up here on Thursday. We'll go into that in detail and how to put those pieces together. But lots of announcements coming out this week, lots of press conferences, Fed statements, got interest rates. So should be plenty of volatility for you to take advantage of. Do it with capped risk. Check out Nadex. Definitely, have tight stops if you're not, and, just beware. All right, I hope y'all have a great trading day, great trading week, and I will see you Thursday on the Diagnostic Trading Hour.